Hello, guys. My name is Joseph Ejike Oji, and I'm happy to keep you company tonight. Our topic of discussion today is the cost of consumer credit. When we say consumer credit, we are referring to those advances or monies that are made to, I would say, loans that are made to individuals to enable them to meet their expenses. So such loans enable them to meet expenses or to purchase on a deferred payment basis goods and services that they need for their own personal consumption. So we call them consumer credit. Sometimes you can call it a personal credit. And good examples here include credit cards, loans, personal loans, and so on and so forth. There are a few things we need to understand about consumer credit. Generally speaking, in commerce and in finance, credit means the transactions involved in the transfer of money or other property on promise of repayment, usually at a fixed future date. So the creditor becomes the person that lends you the money becomes the creditor. Now, and you that receive the money, you becomes the debtor. In other words, credit and debit are simply terms that describe the same operation viewed in opposite standpoints. So the transferor, let's say the bank that gives you the money is the creditor, and you that receive the money or the loan is the debtor. Another thing we need to understand about consumer credit is that the principal function of that credit. Now, the principal function of that credit is for you or the creditor, or let me say in general, the principal function is to transfer property from those who own it to those who desire it. For example, let's say that you want to buy a house, and the house costs, the house of your dream costs $300,000, and your income is only $70,000 a year. Now, how long will it take you to save to buy that house? Because even though your income is $70,000 a year, after tax, you might end up going home with only $50,000. So how long? Then you have other bills to pay: rent, utilities, food, etc. So at the end of the month or at the end of the year, you see that you won't be able to save much to buy that house that is cost $300,000. So that means if you want to make that kind of savings, it might take you up to 10 years or even 15 years to save up the amount that you need to buy the house. By that time, the house of that particular standard, the price have already gone up, probably by more than 30%. So the amount that you already save will not be able to purchase a house of that type 15 years from now. And besides 15 years from now or 20 years from now, when you will be able to save the money, maybe you have advanced in age. You may not be too young enough to enjoy the house. So why not go to the bank, borrow the money, and buy the house now and pay it off over 20 years or 30 years. By that time, by the 20 years time or 15 years time, you're already paying off the house and you have enjoyed it. So credit help you to enjoy it. The function is to transfer property from those who own it, like those who have the money to lend you, like bank, to those who wish to use it, as in granting loans by banks to individuals who plan to initiate or expand their business, or to buy a house, or even to buy a car. So another thing is this: the transfer of money or fund when it comes to consumer credit comes at a price. That price is called interest. and this interest varies. Now, there is a law that we call the Truth in Lending Act. This law became effective since 1969, and it requires that those that lend money as lenders, like banks, even insurance company, banks especially, we say banks, and some shadow banks, what we call non-bank financial institutions. So the Truth and Lending Act requires that all relevant terms of credit extension, a better way of putting it is this: it requires lenders like banks to reveal to the borrower all relevant terms of credit extension, things like the down payment that is required for that loan, the amount of installment payment, and any other type of charges that the loan may carry. So the law, this Truth in Lending Law Act, requires the lender to make the borrower to be aware of all these charges so that they will not be caught unprepared when they start paying back the loan. Now, let's look at the cost of consumer credit itself, which is the main topic of this lecture. Let's start with usury. Call it usury. It's a very ugly term, because usually it means the act of lending money at an excessively high interest rate. Things like the payday loans, I'll call them usually because the interest charges is very high, sometimes up to 30% or even more. So those lenders who exhibit such unethical behavior of charging excessively high interest rates, we call them loan sharks. We have private lenders that does that. We have some, especially I say payday loan. There are another type of loan that one can use his car or her car to borrow money. So because of this, that some states consider this practice to be usual. Some states actually banned such type of loans in their domain. For example, the state of Maryland banned payday loans. They don't approve it. Now, the state of Delaware actually allow loans with a car. One can borrow money with his car in the state of Delaware, but it is not allowed in the state of Maryland. So a few things we need to know about the loans and interest, because some people might say that interest is not a good thing. Well, interest is the price for borrowing money. Now let us look at this situation. Lenders, of course, are in the business of making money. So the rate of return on the money they want to lend. So without question, they deserve to earn a fair rate of return to compensate them for their time and the risk that the borrower may not pay the money. So that's why interest is important. Another thing is this: if the lenders if they're not going to make money from lending money, that means they will not lend. Why would I lend money to somebody I don't know if I'm not going to make money from that? If without the existence of interest, a lot of things will not happen in the economy. It will stifle the growth of the economy. It will stifle. It will prevent. It will make it so difficult for the economy to grow without loans. So without those money, the interest that they're making, that interest that gives them the incentive to lend money to somebody to start business. Without that interest, nobody will want to lend you money. That means businesses cannot grow. That means the economy will not have jobs. They can't create jobs because they're not growing. Because the only way you can get a loan that if there's no interest, there's no lenders that charge interest, is to borrow from your relatives. But the kind of money you need to run a business, your relative cannot give you that kind of money. We're talking about $50,000, $100,000, $200,000. It's very hard to see a relative that give you that kind of money. But because lenders can make money by charging interest, they are willing to lend you that kind of money. So when more people borrow that amount, they start businesses, they create jobs, and the economy grows. So interest or the charging of interest is not really a bad practice. It is when it becomes excessive or predatory that it becomes ethically wrong. I'm sure you get the point by now. So to prevent or ensure good ethical behavior when it comes to lending and borrowing, different states they enacted what we called laws that prohibit usury, laws that prohibit the charging of excessive interest. So good ethical behavior is consistent with treating borrowers honestly and fairly. That's their belief. So these laws they made it possible for them to deal with those who are engaged in unethical lending practices. One of these laws is what they call the Consumer Credit Protection Act. Let me make sure you can see that. Yeah, I think you can see it. Consumer Credit Protection Act. So Congress passed this law in 1968, and this law prohibits excessively high-priced credit transactions. The other one is one they call the Truth in Lending. I think I have mentioned it already. So according to this law, lenders must disclose all the loan costs, everything about the loan cost, the interest amount that will be charged, the service charge, loan and finder fees, etc. Anything that's involved in that loan, so that the borrower will not be will not be caught unawares, or will not be unprepared when it comes to repaying the loan. So they must disclose all loan costs, including the annual percentage rate payment of the charge of interest. That's what the Truth in Lending law requires. Okay. Now, let us look at how to calculate the cost of consumer credit. There's one we call the annual percentage rates. So banks, finance companies, and other lenders are required by this Truth and Lending law to disclose all their lending interest rates on credit extended to consumers. So that I just explained that a few minutes ago. So, but such rate is called a contrast. So the contract or stated rate, otherwise known as the annual percentage rate. Now, the method we use for calculate annual percentage rate is this: APR equals to R times M, where R represent the interest charged on per period, and M is the number of periods. Now, I'll give you an example. If a car loan that charges interest of 1% per month, we have an APR of 12%, because every month they charge you 1%. So 1 month, we have 12 months in a year. So 1 month is 1%. So you calculate it by multiplying by 12, that will give you 12% APR. So for each month, to the loan balance, we have each month they will charge you just 1%. The problem with this method is that it misstates the interest rate. And because of that, we prefer in finance to use what we call the effective annual rate. This effective annual rate take effect of, factor in the effect of frequent compound or periodic compounding. As a matter of fact, it means that it's a simple way of explaining this is that it means that you pay more finance charges, more interest charges. Let me give you an example of this. So, while the annual percentage rate misstate the true interest rate, the one that lenders usually use most of the time is the effective annual rate, or what we can sometimes call the effective annual yield, which consider the effect of periodic compounding or periodic charges. Let me use a diagram to explain this. Suppose you took a loan. Let's say you took a loan that is $100. Okay. Let's say it's $100. Is the amount that you choose, loan amount. Loan amount is $100. So let's say that this is January. First balance is $100, right? Okay. Now, so to find the balance for January, that's $100 times, okay, and the rate is 2%. So the general balance will be, I'll do it in a calculator. It's gonna be 1 minute. I make it easy for us. So we have it as $100 times, okay, 1 plus rate of 2%, but it's 2% annually. I mean, sorry, monthly, times 0.02, 102. So we have 102. $102. I'll take you to the. So January is $100. This is how much you borrowed. Okay, $100. So in February, it's going to be. This time you didn't pay the amount this month. You still owe the money, so you didn't pay the balance. So it's gonna be 102 that you owe in February. And now, in March, the interest charged per month is 2%. So you're gonna do the same $100 March, $100 times 1 plus 2%. See, that will give another $102. So that in March, you are paying based on the APR rate is $102. So you follow that pattern, $102. See? Okay. Let's say that this is how much you pay. See? 102, 102, 102. Okay. You can see it right here. Now, so it doesn't consider the that interest, the effect of periodic compounding. Now, but for effective annual rates, the first one is $100, right? So you have your $100. Okay. Now, for the month of February, you're going to be 100 times 1 plus 2%, 2% interest. One is just a part of the formula. It's $102. So we have $102 here. Okay. Now, this $102 become the new balance. See? Become the new balance. So now, in March, interest will not be charged on $100. Instead, interest will be charged on 102 because the unpaid balance, the unpaid interest, it became capitalized. See? So that's why you say it consider the effect of periodic compounding. So instead of charging you the interest on 100 only as you have an APR, it will charge you the interest on the unpaid balance plus the unpaid interest. So interest is charged on interest. See? So next month will be you're gonna pay this. So instead of here, you're gonna put 102 here. So that you're gonna pay 104. Your balance will now become $104.04. 104.04 cents. Okay. 104.04 cents. See? Now, for the month of March, oh, this is March, this is April. Their balance will now become, now the interest will be charged on not on $100, but on this unpaid balance, on this 104.04, not on $100. So we have it as so 104.04, $104.04. So your balance will now become $106.12. Okay, $106.12. $106.12. So you can compare the two. I can see that this first one does not take care of the periodic compounding. The effect of frequent compounding does not show in this, but it shows here. And when you add these two total to the lender, how much you pay. So you have 102 total will now become, so you add this, and that will give us okay, 100 plus 102 plus 102 plus 102. We have $406. $406. So $406. Okay, for this other one, we have, let me write it down before I do the calculation. So I have 100, 102, 104.04, 106.12. So let me go and add it. So you can see the difference between effective annual rates. 100 from 102 plus 104.04, then 106.12, 412.16, 412.16, 412.16. So you can see the difference in the amount that you pay. So that's why I see lenders use more of this effective annual rate, because it factor in the effect of frequent compounding, and they make more money through that way. And most of the credits, personal loans, are based on this effective annual rate. They will advertise the periodic rate, the annual percentage rate, but then their computations will be based on this effective annual rate. So let us go back to the work we're doing. I believe that you got the point now. At this point, we are going to do some work, some calculations, how to calculate the effective annual rates. There are two methods. First one is if you have the periodic interest charge, then you can use this formula here. Effective annual rate equals 1 plus R to the power M minus 1, where M means the number of periods in a year. A simple way of saying it is that it means how many times you pay in a year. Now, if they give you the APR, in that case, divide the APR by M to get your R, and then plug it into this formula to multiply it. The second method of doing it is to use the spreadsheet method. They give you the effective annual rate, which is a nominal rate. Then you can just use the effect function, which is written in this form. Okay, effect parentheses nominal rate, comma, number per year. That's number of period per year. Now let's try both of them. How find the true annual interest cost of credit card, that's the effective annual rate, that advertises 18% APR. So usually, if you look at the credit card, when you are giving the credit card, there's some of the document that follows it. They give you the APR. So, but the actual amount you pay is the effective annual rate. So even though it's 8%, you pay more, as I will show you in this computation. So using the method 1, since the credit card charges are assessed monthly, which is M, then our M is 12. So they give us the APR. So that means to get the R, which is the periodic interest, that's monthly interest. We divide APR by M, that is 18% divided by 12. That gives us 1.5%. So our M is 12, and our M is 12, and our R is 1.5%, which is 0.015. Now we can plug it in then in this formula. Let me write this down, and when we can plug them in, so that we can get effective annual rate becomes our M is 12, and our R is 1.5%, which is 0.015. So the EAR, which is the effective annual rate, is 1 plus R to the power M minus 1. So you can see right here, I wrote it here, 1 plus 0.015, 1.5%. When you write it as a decimal, it will give you 0.015. I can show you in a calculator, so you can see what I mean by that. So 1.5%, when you want to write it as a decimal, is 1.5 divided by 100, because as you know, percent means per 100. That gives you 0.015. So that means, and our M is 12. So plug in 1.015 for R here and 12 for M here. That gives you this equation, the minus 1. So let's put it in the calculator so you can see how the answer we get from this. So we have clearing this. Okay. 1 plus 0.015. Okay. Raised to the power 12. Okay. Then minus 1. See, 0.1956. See? 0.1956. Which when you multiply it by 100, gives you 19.56%. So you can see from here, the same thing we have here, 0.1956, which is 19.56%. So this means that even though the annual APR they advertise is 18%, the actual interest you will pay will be 19.56%. So a true interest charge on a credit card with an 18% APR is really 19.56%. So that is how it's calculated. Another way you can do it is to use the, like I said, method 2 is to use the Excel spreadsheet. Here, nominal rate is 18%. So if you go to Excel, you put the nominal rate of 18%, say nominal rate is 18%, which is 0.18, and number of periods is 12 months. 12, so that the effective annual rate equal, you can see the formula right here. So effect, opening parenthesis, you can see the nominal rate here, which is 18%, comma, number of periods, MPERY is 12, and close the parenthesis. Then press the enter key. You see get 19.1956, which if you format it as a percent and make it see 19.56%. See the same thing we have by using the formula 19.56%. If you go to our answer in the presentation, you can see it here, which is the same thing that we have when you use the formula. Okay, so that is how to calculate the cost of consumer credit. No matter the APR that they give you, I hope you enjoyed the lecture tonight. And if you do, please, when you have the chance, subscribe to my channel so that you'll be notified when there's a new lecture available. Thank you, and you have a good night.